please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Okay, from the time that we started at 11, we are down about 15 points. We started with a 30-point cut, down 45 now, 10,000-point cut, down 45 now, 10,153. So, you know, the pace on the way down is actually picking up. As we go along, the Sensex is down about 92 points or so right now. The Bank Nifty is down about 0.5% as well. Ashwani Gujral is with us, as always, on the top of 11:30. Ashwani, thanks very much. Good morning. So your sense of things, you know, in the morning, I think right after opening at about 9:30 or so, I heard you were saying maybe things pick up on the way up today. It's not happening. We're selling off now.
And that is the reason why you should be short, because at previous lows, generally there has to be some sort of a bounce. If that is not available and people are still selling even at previous lows, then that shows what kind of weakness the market has. The other thing is, as we get to the end of March, you know, the momentum is picking up. So now, you know, people are selling on all stocks, even IT. So DIIs are selling, FIIs are selling. So it's basically now a one-way train, which is in such strong momentum that it is not really respecting supports, etc. So the idea should be to get short and stay short, because right now you have 1340 decliners and 280 advancers. So basically the entire mid-cap space has collapsed. Now what's left is those 4 or 5 large stocks. So I think today's afternoon could be as gory as Friday, and the next few days till probably 31st March are going to be fairly similar. See, politics, etc., you know, often becomes an excuse, because the market is intelligent enough to know that the current government has no threat. But obviously you can build a narrative that maybe 2019 is this, that, but we would have fallen anyway. You know, politics is just an excuse.
Okay, fair enough. Ashwani, can you just reiterate or give us a sense in terms of how important the 200-day moving average would be for the Nifty and the fact that now we've slipped below it?
See, the 200-day moving average is an average which is used by institutions and by several large players to assess the strength of the market. It's the average of the last 200 days, an equilibrium level. Often this is a great buying area, but when it gets sliced through like it is getting right now, that obviously means that there is more weakness ahead, and you'll have sharper weakness, because below 200 a lot of people don't want to buy. So that way I would think the fall will accelerate. Sometimes, you know, the accelerated fall is the final phase. I think the way we've taken out 10,150, you should break 10,000 also at some point.
Okay, Ashwani, what would you be trading in terms of stocks?
See, Balrampur Chini is a sell with a stop of 86, target of 74. REC is a sell with a stop of 127, target of 115. LIC Housing is a sell with a stop of 512, target of 490. Just one more point. What was last couple of years characterized by? Large mutual fund flows. So till the pain does not start there, my sense is the market will not bottom out. I mean, you need to hear some screams from those guys, the, you know, SIPs should fall, etc. If they are not falling, then the market will fall further.
Okay, we have some Twitter queries for you, Ashwani. First, Pankaj has 250 shares of TV today at 400, wants to know the way forward.
Well, it's outperformed. It hasn't fallen in line with the market, although today it's down. So maybe you should keep a 430 type of a stop and maybe expect 650. But in this sort of market, you know, any stock can go down. Overall, media space, etc., has held up fairly well. So if he's that long-term type investor, he should stay put, and maybe in the next round, he'll get prices closer to 650.
All right, Ashwani, thanks very much. Appreciate you joining us with that perspective. We'll speak with you later in the day. Pretty visual way to put it, right, Ekta? Until you hear screams. You can almost visualize it, unfortunately. But okay, we are what, down 46 points now at the day's low, and it's not looking good. Advanced decline was looking poor, is looking poorer still as of now. Okay, we got you the technical perspective, and now it's time to get you a quick fundamental perspective on things. Mehrab Irani is General Manager, Tata Investments at Tata Investment Corporation. Mehrab oversees almost about 10,000 crores in investments in Indian stocks. He doesn't depend on mutual fund inflows. Thankfully, Mehrab, morning you heard Ashwani, you would say thankfully?
Yeah, we can say thankfully now.
What's your sense on the market, Mehrab?
Yeah, good morning, Prashant. If you see the third quarter results of most of the companies have come, the top line or the sales growth have been close to 13%. The EBITDA growth has been around 7% with a 50 basis point expansion in EBITDA margin from 20.5 to 21%. Also, the bottom line PAT growth has been close to 8% and the margin has been steady at around 10.2%. If you see valuations, as we all know, today we are not cheap. On a current year basis, we are almost 21 times price earning. Or a forward basis, we are close to 17, 18 times with almost an 18% expectation in earnings growth. Also, price to book value, we are around 2.9 times when the ROE is around 14.5%, which is like 100 basis point below long-term averages. So the valuations are at least like 12 to 15% premium to long-term averages. Also, if you see currently the market cap to GDP is 90%, which is again costly. Plus, if you see recently the interest rates in India have risen almost by 100 basis points over the past few months. So the bond yield minus the earnings yield have also gone up, which means that either the market is expecting the earnings to go up or the interest rates to come down, and both of that look a challenge as of now. Even if you see the expectations of earnings growth going forward, a lot of expectation is, from the global cyclical sectors, be it metals, be it oil and gas, etc., plus the PSU banks. So those also have recently got their own problems. Even if you see the global valuations today, the US Dow Jones is also trading at around 23 times, which is like a last few year high for that market also. And if you see even the fiscal deficit in the US has recently increased, it's gone to $700 billion, and analysts are predicting around $1 trillion over the next 18 to 24 months. And the US Treasury has also gone up by 80 basis points in the last few months. So this all not prove good for emerging market flows and emerging market equities as well.
Okay. Mehrab, for this year, I think what would probably be the biggest talking point domestically is politics. How big a risk do you think it is, especially going into elections?
I think a few months back, it was not such a big risk, but recently what developments are happening, I think we cannot ignore it, and particularly, our election-heavy calendar, which we are going in, leading to the general elections in 2019. I think we have to pay good attention to whatever political developments are happening, because I think that is a certain risk to Indian markets, because the whole, if you see this bull market started from the time just before this new government came. So if that political stability were to be a little challenge going in the next few months, I think that would be another challenge for the markets.
Is it a big enough risk for you to probably rejig your portfolio, hedge your investments?
See, as of now, it is not, but we have to, this is a dynamic situation, and we have to keep monitoring it. And if we see any kind of negativity going forward, then I think we have to be very cautious on that front.
Mehrab, so markets, again, to come back to that point, have to correct between 12 or 15%, simply put? From even these levels to get to comfortable levels?
Yeah, if you see, it has to come to long-term valuations, then either we have to correct by, as you said, 12 to 15%, or the earnings growth have to be much higher. See, today we are projecting 18 to 20% growth, but whether that will materialize or not, we don't know. And particularly the legs on which it is projected, those are also a little challenging. So I'm not sure on that.
No, this 12 to 15% expensive is based on 18 to 20% earnings growth.
Right. It is already based on around 18% growth.
On that, we are not really very sure.
On that also, we are not.
Couple of years
yes, on that also, we are not really very sure. So, but if the earnings growth comes, then I think it will continue to remain expensive. But if the earnings were to falter, then I think it would be
What is your view? 18 to 20% and 19? Possible?
See, if you see a lot of the delta in earnings are coming, as I said, from global cyclicals, metals, oil and gas, PSU banks, and some of these sectors have gone into little challenge over the past few weeks. So I'm not sure how much that will play out.
Okay. PSU banks obviously is the other big risk, or is it a risk? I should ask you that. And how are you approaching financials, PSU as well as private?
So if you see a couple of months back, some positive news on NCLT, etc., was coming for PSU banks, and there was some kind of hope that all this will get resolved. And again, the credit growth will pick up. But whatever has happened over the past few weeks on the the fraud which has happened in the banking and financial services sector, this is little worrying. Whenever any problem happens in the banking and financial services sector, then the problem is little more elongated because it affects different parts of the economy. I think next few quarters it would be a big challenge for the PSU banks to actually lend. So whatever little nascent growth which we were seeing in the infrastructure capital goods phase, again that may also be a little challenge. So I would be little concerned on that front. As far as the private banks are concerned, they are obviously doing quite good. The credit growth is very good, between 15 to 25% for most of the private banks. The NIMs remain very good. NPAs are quite low. Only thing is that a lot of the recent growth in private banks had happened through a lot of the retail lending and the unsecured book lending. So as of now there is no problem, but how this cycle plays out over the next 18 to 24 months, that we have to see. But yes, private banks overall are looking quite good. Valuation is slightly extended.
Typically, Mera, in the AUM that you manage, what is the proportion of exposure to mid caps historically?
Historically, the proportion to mid cap it's keep varying. So as of now,
more and more people that I speak to, they say that we are now overwhelmingly into large caps. I mean, that may be to limit exposure, risk, etc. Is that true?
I think that is true for most of the market players.
I mean, so you are now overwhelmingly in large caps.
I would not say that way, but yes, we would remain slightly cautious on the market at this point.
Okay. How are you approaching IT stocks? Outperforming this year? Are you bullish? Are you increasing your weightage?
Yeah, if you see IT stock after a long time over the past few months have actually outperformed. Today the valuation of the IT sector is around 18.5 times. So after this outperformance, that is also trading at 15% premium. But I am still not sure about a lot of the large cap IT stocks. I hope it is not a value trap. So, but the mid cap IT sector, a lot of stocks are looking quite good. So selectively, yes, I think we should increase exposure in IT stock, particularly in the mid cap space.
Could you rate in terms of allocation top, say, 3 sectors?
Yeah, I think, as I said, private banks would remain one of the top sector.
Yes.
I think autos also continue to do quite good. The numbers in the passenger vehicles, the two-wheelers, etc., the numbers are quite good and they are encouraging. So I think that remains. No doubt the valuation is very high.
Sure.
Like the top passenger vehicle in India, companies quoting at 50% premium to its own historical valuation. So the valuations are quite challenging over there, but the growth continues to remain over there. So there I'll remain positive. Also, if you see the consumer, the FMCG space, that is also doing quite good. Again, the valuation over there is at least at a 30% premium to long-term averages of that own sector. But still, if you see the volume growth is again coming back to the consumer space, the channels are also improving, the wholesale and the retail channel, both after the demonetization and GST disruption over the past few quarters. They are now again trying to stabilize. Plus the cost inflation which that sector was seeing, I think that is now again receding from this quarter. So I think the earnings in that sector should be in line or beat expectations. So though they are costly, we would continue to remain positive.
So in that sense, actually not very much has changed, right? I mean, not just for you, but for the industry as such.
Yeah, I think
it always
so.
was private banks, consumer staples and autos.
Yeah, I think that same thing, what was people are liking, the positive news are coming on that, and what people are not liking or underweight, continued negative news are coming on that, like PSU banks and etc.
All right, a pleasure speaking with you, Mera. We're going to wrap it up on that note. Thanks very much for joining in and talking to us. So that is some fundamental view coming on the market. For the Nifty, in fact, we're down around 52 odd points. We're at the low point of the day. 10,143 is where we're at, and the mid-cap index too at the low point of the day, down to almost 300 odd points, and the advanced decline ratio is still extremely weak. IIFL has published a report on pharmaceutical companies, and it specifically analyzes US business margins. In fact, the title of the report is Cost Focus Unlikely to Solve Growth Issues for Pharmaceutical Companies. We're joined by with Abhishek Sharma, the Vice President and Pharma Analyst at IIFL, to take us through this report. Abhishek, hi, good to see you in after a very long time. Just take us through what your synopsis for the US market is when it comes to, say, pricing pressure, new approvals, as well as what would that eventually result in when it comes to margins. But before that, Abhishek, I just want to point out that the Nifty is now at a fresh 2018 low. So that is something that we should take cognizance of, because we seem to have cut through the 200-day moving average very rapidly, which was 10,161, and we seem to now be at the lowest point of the Nifty for the entire year, which stands at 10,141. So I'm sure that despite it just being a level, it definitely is a sentiment burner as well.
You know, people used to refer refer to it as a Lakshman Rekha. And so it is an important level, no doubt. But remember, the fact also is that the market moves up, the averages also move up.
Yeah.
Right? I mean, so it's not a constant thing. And the fact still is that we are down, what, 10, 11, 12% or so from the all-time high. So, I mean, just to keep that in perspective when one looks at these, breakdown below averages, but still, it's an important level. I think the previous low for 2018 was 10,141, and we made a low of 10,139, and we are back above that now once again.
So it is definitely something which hits sentiment. But Abhishek, let's continue our conversation then. US markets and pharmaceutical companies, your synopsis.
Yeah, so basically, see, in the sum of the parts report that we put out the second edition for, basically what we are trying to say is that there has been 1200 bips kind of a margin erosion for Indian companies which are serving the US generics market as a whole. And out of that, half of the margin erosion has come because of the price pressure, and the other half has come because of increased R&D activities. Now, I guess, I mean, both these things go hand in hand with each other. When companies started to see that their bread and butter generics business is not going to grow from here or is going to erode in margins, that's where the emphasis on increasing R&D spend started. So that's one part of what we essentially put out. The other is what we also seem to now believe is that the market is assigning a differential multiple to the US generic story, which is lower as compared to the earnings that the companies make in India and rest of the world. And because of the lower multiple assigned to US as a generics, the corresponding EBITDA declines from here in US, or earning misses in the US will not attract that kind of price movement that we have been seeing in pharma stocks in the past few years.
Why are you saying that, Abhishek? I mean, if earnings disappointments continue to be pretty sharp, why wouldn't prices react?
Yeah, so see, there are two parts to valuation. First is earnings, and as we have highlighted in our note, there are pockets of risk which are still there out there, because there are company margins which are still dependent on specific big products which are going to continue inviting increased competition. So on that front, we have highlighted. But if you are already assigning a lower multiple, let's say, to a particular business, then when those earning misses come, the correction, because essentially the stock price is a earnings into a multiple. Since the multiple is already low, the corresponding hit on stock price will not be that much. Although I think the key highlight that we are still trying to put out is the fact that the earnings continue to be at risk.
Okay, conversation with Abhishek Sharma of IIFL. Abhishek, so tell us about your picks within the pharmaceutical space then, and the rationale behind it.
So we essentially remain focused on companies which have a higher share of EBITDA coming out of India and other markets, as compared to US, where we still see challenges going forward in terms of pricing pressure continuing. And on that parameter, we would essentially like companies like Torrent and Alchem, which continue to derive a lion's share of their EBITDA from this market. We also like Biocon because it's a biosimilar story which is nicely played out in the last 1.5 years, and we believe that biosimilars is going to be a sustainable opportunity going forward.
Okay. All right, Abhishek, we're going to wrap up on that note. Thanks very much for joining in and speaking with us. So that is the view coming in from IIFL on the markets, or rather on the pharmaceutical space. But for the Nifty itself, we've recovered a little bit from that Nifty low of 2018 of around 10,139. So we're back at 10,150, but extremely precarious at this point in time.